Micron Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at Ausbiz. So, all about the US Federal Reserve overnight, holding interest rates steady as forecast, but now sees just one interest rate cut this year. The decision coincided with US CPI inflation, which was unexpectedly unchanged for May.
Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high.
Well, having forecast 0.75 percentage point reductions in March, the Fed Policy Committee's set of projections now make it unlikely of a cut in borrowing costs before the November presidential election.
If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals.
The new projections show the economy is still expected to grow at a slightly above trend of 2.1% this year, despite a sluggish first quarter, and the unemployment rate to remain at its current 4% through the year.
You don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Well, US Treasury yields dropped after the inflation reading, which came in at 3.3% for the year to the end of May. The yield on the benchmark 10-year Treasury note fell 8 basis points to 4.32%, and the 2-year had its biggest daily drop in a month, down to 4.75%. And the inflation data saw the US dollar fall, but paired losses after the Fed's updated interest rate projections for only one rate cut this year. The Aussie dollar trading at 66.6 US cents. Well, softer than expected inflation cheered investors on Wall Street, who sent the S&P 500 and Nasdaq to record closing highs for the third consecutive session. The enthusiasm was curbed by lower interest rate cut expectations. Apple shares extended their strong gains, with the company briefly again becoming the world's most valuable, dethroning Microsoft from the top spot. Oracle shares surged after the software provider forecast double-digit revenue in fiscal 25 after the bell the previous session. And chipmaker Broadcom raised its annual revenue forecast and announced a stock split following a rally in the stock, with Wall Street betting on the hardware that supports the generative AI technology. Meanwhile, European shares closed sharply higher after the CPI report in the States and prior to the Fed's rate decision. All right, well, let's get the wash up from that inflation read and, of course, the Fed decision and the projections. Ira Epstein joining us from Lynn and Associates. Ira, very good to catch up with you. Lots to digest there. All right, what's your broad takeout of what you heard from the Fed?
Well, they're still data dependent. They're not trying to get ahead of the curve. They're still being the data dependent part, and they have to leave that at some point if they're going to avoid a harder landing than they're talking about. At this point, the economy's strong. No getting away from that. We did see, as you know, on Friday, the jobs report showed that the unemployment rate did go up to 4%, and we saw that the new jobs came in at 272,000. Now, one of the things the Fed chair said is those numbers might be a bit high. So in other words, there could be revisions coming in, but the labor market well balanced. They don't blame, and this is what the Fed chair said, wage inflation to be the cause. They can't seem to get rid of the rent inflation or the housing costs. They're staying very strong, but we are seeing that new cars fell in value, used cars went up in value. We're seeing that insurance fell a little bit through this. We get the PPI tomorrow. And probably the most important thing is if you think back, we're here in June. At the beginning of the year, there were talks that we're going to get 1.5% at least in rate cuts this year that we're in. Now we're talking 25 basis points, and we're talking getting 100 basis points next year, and then the year after that, another 100 points. I can only say maybe. Everything will depend on how everything goes. And the one thing that bothers me, the higher we're going in the stock market now, which has got about a 14% return baked into the S&P. I mean, that's a pretty big number. It gets scary up here at some point, and it's all concentrated on AI. I mean, Apple, NVIDIA, Broadcom's now making its move. ARM has made its move. But these are all the AI parts of it. And don't get me wrong, there are other parts that are being dragged along. Even our motor stocks, GM, they're buying back another $6 billion in shares after the $10 billion that's just about to be bought back now. So that's quite a bit of money they're throwing. Is the economy good in the U.S.? There's nothing like it. It's really that simple.
Ira, would the Fed be comfortable cutting rates with equities at record levels?
I don't think they look at equities. That's not their focus. Their focus is employment and inflation. So what the stock market does, they shouldn't be listening to that, just as they shouldn't be listening to who's going to be the president, what's going to be there, can they make a cut in November? Why not? I mean, they're already accused of being political. They'll do what they have to do when they do it. So the answer is yes. Should they? Well, that becomes the bigger question, all right? Because now what we're really saying is, does this market even need a cut? That's really what your question's about. And so far, the answer is no. So if we need one, it's to get ahead of the curve, not because we need one today.
What did you make of the market reaction given those dot plots? I mean, does this add certainty or contribute to further uncertainty, do you think?
I thought we had an overreaction to the CPI. The big event to me was not the Fed. It was the CPI numbers in the morning when I was looking at them beating by a tenth to 2/10 on almost every category. And that was the number that everything focused on. And we took off to the races. You saw the metal markets go up dramatically, the dollar fall. Actually, after the Fed came out, you had the moderation take place where the market started giving back the gains in the stock market. You actually took the two markets that have been the weakest, the Dow and the Russell, sharply down from their highs, and the dollar rebounded almost half the loss that it had during the day. So those were the parts coming in. Did we overreact to the CPI? Most likely. Tonight, we're going to have to see as we get ready for the PPI tomorrow. They're looking for that number to come up month over month, about a tenth, higher month over month, and the core PPI to be up 0.3. Those aren't weaker numbers, so you'd have to beat those to get another bullish reaction.
Ira, does the trend in inflation and what you've heard from the Fed alter your investment strategy at all?
No. The strategy is still one where the AI stocks, they are considering this like just the day that we first saw our first Apple iPhone. And that's how AI has to be treated by the market. And as you know, Apple became, and it is, as of tonight, the most valuable company in the world. Just think back 3 weeks ago, 4 weeks ago, that stock was 165 and in trouble. And now the stock is near 220. And Apple did something brilliant, and I give them all the credit. Instead of throwing away a lot of money, they're going to use ChatGPT or other markets at the beginning, let the market come in, don't deliver an awful lot, but deliver enough to make a new phone sale mandatory. So if you don't have an Apple i15 or higher, you cannot get what you need in the marketplace in order to work with the new features that are going to come out. So that's going to get their sales going. Then they save billions, if you will, by not developing just yet their own chip. Wait, see how this all works, and develop your chip as you're going, but don't spend like so many of these other companies. That's what the market liked. When I saw that, first thing I said in my newsletter, they have it. They've got it. They figured this out, and they have rallied because of that.
Sounds as though your Apple device there is reminding you of its capabilities, Ira. Hey, what are you making of the US dollar at the moment? And of course, I know you like gold. We did see a precipitous fall late last week. Do you remain in favour?
Yeah, all the metals got hit hard because of the lack of the inflation, the worry about where we're going. But if the dollar's going to drop on any of this news over interest rate fears, that's one of the supporting factors, gold will come alive. Let's understand what the Fed is doing and what the CPI numbers are. Nobody's saying that inflation is falling out of bed. It's working its way lower, which favors the gold market still. But is the gold in a buying mode here? It isn't, nor is the silver, nor is the copper, nor is the platinum. About 2 weeks ago, the rug was pulled out from all those markets, and they've been in corrective territory and coming down. Is this the time to accumulate them? I don't think just yet. I think that this is the wait and see where the bottom shapes in all the markets. What hurt copper especially is China has enough copper on the ground. They're not getting big demands. There's more tariff wars going. Take a look at Europe now. They've just put new tariffs from 17% to 38% on electric cars coming in from China. Well, what do you think China's going to do to Mercedes-Benz and BMW and other cars there? They're the big engine cars. You don't think they're going to slap them? So there's going to be problems here. And we're nowhere near out of this mess. All these tariffs are terrible. I don't know what else to say. Make a better product and you don't need them.
Ira, thanks for joining us from Linden Associates.
Thanks for having me.
Quick check of the local market when we're about to get going in just a couple of minutes' time, of course. And we can see SPI futures up there at 0.2%. So set to snap those recent losses that we've seen this week. Stay with us. The Open is just a couple of minutes away.